Good morning and welcome. I'm Warren Dueck in Vancouver.
Good morning, and I'm Krista Rabidoux from Calgary. Today we're going to take a little bit of time to talk with you about moving to Canada. And although primary focus of our webinar today is moving from the US into Canada, a lot of the subject matter that we're discussing is also going to cover people coming from other countries. Although a lot of it is focused primarily on Americans coming up to Canada or people moving up north.
We're going to try and keep this to 1 hour maximum, though if we have extra questions, we'll also take time to answer those as well. Make sure you input your questions on the question and answer, the Q&A box in your screen, and we'll do our best to get to those questions. We know that a lot of our attendees today are financial advisors, so we want to give you information that you can talk to your clients about. Now, this is some of the material we're going to cover today, and it's going to, we need to advance the screen there. Thank you. So the information we're going to cover is on top issues for people moving to Canada. And, you know, moving from one country to another is one of the most significant tax opportunities and problems that most people have in their lifetime. Now, many people think, you know, Canada, the US in particular, are really similar. But you know something, when it comes down to tax law, it's the differences that count. If we have an opportunity to do more content here because we have extra time, we're going to add some other pieces here too, but make sure you put your questions in as we go along. We're going to start with talking about tax residency here, and Krista's going to help us with that.
Sure, thanks, Warren. So the first thing we need to look at when we're talking about tax residency is what each individual country looks to in determining whether or not you're a resident. Canada and the US take slightly different approaches when looking at residency. The Canada side looks at more of a subjective approach, and the US side has more of an objective measure when they look to determine if someone is a resident of the country. Under Canada's rules, although they had the sojourning rule of 183 days, a lot of what they look at is the actual residential ties that you have to this country and whether or not you have a significant amount that may treat you as a resident for purposes of taxation. Now, the US side, they're more objective in their approach in the 183-day calculation that they use. It could be 183 days or more in a current year, or it could be over a 3-year period. Now, a lot of times we have some individuals who maybe only are spending 120 days in the US and surprised to find out that they're a resident of the US under the 183-day substantial presence test. Now, when you're looking at aliens and citizens, it's slightly different. So the US citizens, although they're a US person and have to file continuously, no matter how many days they spend in the US, you still want to look towards the amount of time that is spent in the US for determination of sourcing of income, where they might be, sourcing of income and who gets the first right to income. And so when you're looking at residential ties, that's what you're trying to get to.
So, Krista, a lot of people say to me, hey, you know, I'm in Canada, but I don't have official status here. So I can't be a resident of Canada. Do you have to actually have immigration status in Canada to be taxable as a resident?
Yeah, so no, immigration status and tax status are completely separate and aside from each other. So you could be in Canada and spend 183 days, if you will, illegally, and you would still be a tax resident of Canada for purposes of their Income Tax Act and the way that they do it. And vice versa, if you're a landed immigrant and you have permanent residence but not actually here, you may not be a tax resident of Canada.
But if someone had a home in Canada and they've spent, 10 days in Canada, don't they have residential ties to Canada? They potentially taxed as a resident?
Yeah, well, so that's when you would want to go look at the tax treaty with the country that they're spending their time most in. And you would.
But for Canadian tax purposes, they'd actually be potentially treated as a resident, even though they've only spent a couple of weeks here or something like that.
Yeah, just because of their residential ties. So that's when you're under the domestic law, having a home here in Canada could be enough.
So there's lots of people that are residents of Canada and probably don't know it. Now, oftentimes that won't actually change their taxation, but I guess the question is, what's the impact of residency, and particularly vis-a-vis Canada or the U.S.? You mentioned that, who gets to tax you first? I guess part of it's also who gets to tax your worldwide income.
That's right. Yeah. So if you're considered to be a tax resident of Canada, you have to report your worldwide income for the period of time in which you're considered a tax resident of Canada.
And there's a bunch of filing issues both in Canada and the U.S. If you're a resident, that you have to disclose, interests in non-Canadian entities, or if you're a U.S. resident, interest in non-U.S. entities. So residencies are really interesting, and it's a fundamental subject here too. One of the things that residency, the rules we're talking about here, do not apply to is U.S. estate and gift tax. The test for that is something called domicile, and that's different. We're not going to cover that in this section. So we're going to flip and we're going to talk about the tax treaty and how that works. And the tax treaty has, it's a mechanical test, and as soon as it comes to determination, it stops. In other words, the fact that you might be a U.S. citizen or a Canadian citizen won't be relevant unless none of these other tests are determinative. And the only way to actually get to the tax treaty is where you're a resident of both countries under their respective laws. So if we're talking about the U.S. and Canada, that you're a U.S. resident under U.S. law, and that you're a Canadian resident under Canadian law. And that can happen a lot, as Krista mentioned, that the two tests are different. Canada's subjective and the U.S. is objective. So it can happen a lot where people are actually resident of both countries at the same time. So this test is, like I say, it's a mechanical test that says, where's your permanent home? That's the very first test. Now, a home can be a place that you own and live in. It can be a place that you rent and live in. It could be a friend's place that you live in. Those things all count as a home. It could be a boat. It could be a trailer. Any place that you actually reside in. This is not a qualitative test. It's not which place is nicer or bigger or costs more. It's, do you have a home in that other country that you actually use? In other words, mailing address doesn't count. So it's really a home. If you have a home, a permanent home in neither country or one in both, then you go to the next test, center of vital interest. Now, this is an interesting test because it's a two-part test, personal and economic. We'll talk about the personal first. Generally, the personal test is, where is your spouse? Now, if you're not married and not in a relationship similar marriage, obviously that's not going to count. Unless, for example, you have dependent children. Now, I'm not talking about children that you send checks to. I'm talking about children that require you to be present to actually look after them. So having a child in university in another country doesn't mean your center of vital interest personally is in that other country. It's the question of someone who needs you to be caring for them on a daily basis. So that's a center of vital interest personally. Generally, where is that spouse located if we're talking about someone who's married? If you're not married and don't have a relationship similar marriage, then that center of vital interest personally becomes much more unclear as to where that is. The second part of the test is economic. Where's your center of vital interest economically? Now, people make the mistake of thinking that, it's where their wealth is located. But for most people, this is really the question of, where do you work? Where does your work require you to be on a regular basis? And so this is really, where's your office? Where's your factory? Where's the place you show up for work? Now, it's different in these COVID days because that's suddenly changed for a lot of people, but generally that doesn't mean outside the country. Actually, in many cases it does, as we're finding out as tax advisors here, that people are living in a different country. But where's your economic center of vital interest? Think about, this is the place where you work. And where you are retired or unemployed, not working, this becomes a much more blurry question. Or if you're independently wealthy, That's another scenario saying is it becomes less clear. But you can own shares of TELUS or Suncor, both Canadian corporations, and live anywhere in the world. So it doesn't bind you to a specific country. So the interesting thing about this test, it's a two-part test. And you basically have to pass or fail both parts for it to be determined. In other words, if your spouse lives in one country and you work in the other country, it's a split. And that means you're going to go to the next test because center of vital interest was not determined. So the next test is habitual abode. This is a term that's never defined by the Canada-US Tax Treaty, but basically you should remember it this way. You've heard of the 183-day test. This is the 183-night test. Where did you sleep? So if you sleep most of your days in Canada, under this test, if these other tests were not determinative and you get to the third test, habitual abode, you're probably a Canadian resident. Now, tax treaty cases don't get to court very often. And so you don't see a lot of these showing up in court. But courts have said this. It's not enough to have one extra night in Canada or one extra night in the US to be determined. It has to be clear and compelling. So just having a few extra nights in one country isn't going to take you necessarily change your residency. But you should be careful about this. If you need to tie break on habitual abode, that you spend enough nights in that country that you're going to be in, that it is clear and compelling. Now, if all these first three tests are not determinative, you go to the fourth test, citizenship. Where are you a citizen? Well, of course, you could be a citizen of both countries or of neither. In that case, you get to a really unusual situation here. Unusual and usually undesirable. And that you get to something called competent authority. Now, you can debate about the use of the words they're saying, competent authority. Is the IRS and the CRA, are they competent authority? Because they're going to be the ones who decide where you, John Doe or Jane Doe, are actually resident for tax purposes. They sit across the table from each other and they say, who wants Jane? Who wants John? It takes several years probably to get an answer on this. This is a total disaster from a tax planning standpoint. You really have to figure that you're going to win or lose on these first four tests. You do not want to get to competent authority.
Yeah, so Warren, you briefly touched on it for a moment there about the COVID and people spending time in other countries. Is there anything further that should be considered for people who might have spent, say, greater than 183 days, but there's just working there remotely because of COVID and they can? Is there anything they should be aware of? Because the countries kind of has said, we'll ignore this for people who can't get home.
Well, this creates a lot of uncertainty, firstly, in terms of saying where does a person reside for tax purposes. And, sometimes people think uncertainty is a good thing. If you're a tax advisor, and many of our people here are financial advisors, uncertainty is usually a bad thing. So, what you want to do is be really clear in saying where you're at. And you as a taxpayer or your client as a taxpayer is always in control of the facts. So make the facts clear for the answer you want. Unclear is not a good thing because it gives the opportunity for tax authorities to make that decision for you.
Yeah.
Great. Now, Krista's going to talk about tax-free gains.
Sure. So when people are moving cross borders from the US to Canada, primarily this is what I'm focusing on when we're talking about this situation. When you arrive in Canada, Canada is going to give you the bump up in the cost basis of your assets so that any appreciation that happened prior to moving to Canada isn't going to be subject to Canadian tax. Now, we actually have a little bit of a loophole, if you will, a planning that can potentially help save someone a lot of tax money on appreciated gains that happen. And I will say this isn't for U.S. citizens or green card holders, people who are considered U.S. persons until renunciation. This is primarily for people who went into the U.S. to, say, work for 5 years, purchased assets while they were there, and they're looking to come back. what happens is Canada is going to recognize the bump up in basis. The US, once you give up your residency and move back to Canada, no longer under the treaty technically have a right to tax certain types of assets, being stocks, any type of investment type of assets. This creates a good tax advantage, if you will, for individuals who might have some high winnings within their investment accounts. This actually can save someone significant amount of tax in order to create, within their portfolios.
So this makes Canada sound like a tax haven, Krista. Most of us associate tax havens with palm trees and sandy beaches. We do have some sandy beaches. Most of them are covered in snow right now, but this sounds too good to be true.
Yeah, it really does, but it's just a way that when you're reading through the Income Tax Act and the tax treaty together, you get that basis adjustment, and you're able to say, under the treaty, the US, you don't have a right to tax these capital gains if they're not business assets or real property. And in Canada, you've all of a sudden made your basis when you moved across 100,000, and if you sell it tomorrow for 100,000, it's a $0 gain, whereas there's appreciation of say 50,000 potentially. So could be considered a tax haven, as you say, Warren.
So, with a situation like this, for someone who's not a U.S. citizen or green card holder, when they move to Canada from the U.S., they would they wouldn't pay any Canadian tax if, the day after they move to Canada, they sell their GameStop. Is it GameStop? GameStore? I can't remember what it is, but GameStop, the big stock that's up in value. If they have a huge unrealized gain, they come to Canada, they sell that stock the next day, they'd pay no Canadian tax.
Yeah, that's correct.
And if they're not a U.S. citizen or a U.S. resident, they wouldn't pay any U.S. tax, because the U.S. tax has a very, I'm going to call it a muted tax on people leaving the country. It only applies for specific purposes. So this is a huge win, but it's also a significant win potentially for U.S. persons, because when people think of coming to Canada, they don't think, boy, this is a tax haven. No palm trees, no sandy beaches, or sandy beaches only for a few months of the year. Because those U.S. persons will come to Canada and they'll sell their huge unrealized gains and pay no Canadian tax. They'll still be stuck with U.S. tax, probably only U.S. federal tax, not state income taxes. And U.S. tax rates still are generally lower on capital gains, 20% plus in some cases, the Obamacare tax of another 3.8%. So it's really a win for both parties there. I think that's a huge thing. We have a term we use in our firm we call this the home run, because oftentimes it's Canadians themselves who have gone down to the U.S., seen their stock and their super ID appreciate value, and they say, something, I miss living in Canada. I miss winters in Edmonton or Montreal or even Vancouver. And I'm coming back. And they have a huge tax win on that gain, like nothing they could ever get in the U.S. So this has a really significant impact here. One other category I'd like to bring up, but we don't really talk about further, it's not really the tax-free gain in here, but another thing that Canada taxes preferentially is stock options. People have stock options, want to realize them in Canada where they're taxed at capital gain rates, as opposed to in the U.S. where they're taxed as ordinary income. So Canada is actually, we don't give ourselves credit sometimes for having great tax rates. So there's a flip side to, this is the dark side of the tax-free gains, is Canada's departure tax. When you cease Canadian residency, so you come to Canada, you say you love it, and then you say, I miss those winters in Florida. In fact, I miss the summers in Florida, and which I don't think anybody actually misses. But Canada's going to tax you on all unrealized gains on your worldwide assets when you leave Canada. You say, maybe Canada's not so great after all. So departure tax is potentially a very significant issue here when people leave, because they've got $1 million of unrealized gain, and now Canada's saying you owe us tax on that $1 million. Now, There's no departure tax on things like Canadian real property, pensions, stock options, registered accounts. There's a few other categories there too. Those are the major ones. So there's no departure tax on those, but other things there are. Those shares of GameStop that you came to Canada with, you sold some, but you hung on to them. Now they've tripled in value. Again, you'll just be paying tax on your gains since you came to Canada, but that could be a significant amount. Now, departure tax always sounds way worse than it actually is. It's not so bad. You'd pay tax on that gain anyways. Normally, you'd only pay tax and dispose of the asset. But the good news here is that you can defer the tax interest-free. That's the greatest government handout most of us will probably ever receive if we leave the country, which is strange they give us things when we leave the country. But you have to file timely, and you must provide security. The one group of people that have the biggest problem with something like this are people who hold shares of private corporations where they're not the sole shareholder. There's some things that need to be done in advance of people leaving. Now, the good news here, under the terms of the Canada-US Tax Treaty, is Americans who come to Canada and spend less than 5 years in Canada won't pay the departure tax, but only applies to certain assets. Those are really the assets they came to Canada with. So if they bought GameStop before they came to Canada, they wouldn't pay. They'd get a high basis when they come to Canada. If they held it during their time in Canada and left, they wouldn't pay tax on then either. But there's also some exceptions to this category here. So departure tax isn't as bad as it sounds, but it does sound terrible.
Warren, if someone were to leave Canada for a few years, have the departure tax, and then come back, is there a way to fix it or unwind it?
Well, there is, and I think you know the answer to the question, actually, Krista. So, yeah, you can come back to Canada and effectively unwind the tax. There's some limitations on that. Of course, the devil's always in the details on subjects like that. These are things, what you always want to do, and since we have a lot of advisors on the show here today, is planning in advance. Like when people move and then tell you they're moving, like they've perhaps missed opportunities they could have taken advantage of, or they've created problems that they wouldn't have thought about. And this is where advanced planning is always critical. If I had my way with clients, I don't always do that because they call me, but is that people come to us the year before they're going to move because there's some things even they want to do in a prior tax year to prepare for them moving. Now, of course, we're in February of 2021 right now, but if people see themselves moving in the future, potentially 2022, this is the time to start talking about it and then implement ideas as we go along. That's particularly true for individuals that have private corporations and other tax things like trusts and things like that. Mm-hmm. So we're going to flip and talk about foreign tax credits now.
Sure. Yeah. So foreign tax credits, they can be your best friend in the future, as a lot of people saw in 2017 when the tax reform came in. There was a lot of backfiling that had to be done to try and capture foreign tax credits that may not have happened in the past in the U.S. Foreign tax credits is a situation in which the two countries work together to ensure that you don't create a situation of double tax. And in most instances, especially for U.S. citizens living in Canada, the Canadian rates are higher so that you create a foreign tax credit in the U.S. Now, although there's systems in which you can use foreign earned income exclusion, for instance, for earned income, sometimes it's not always the best to use the exclusions that are available, and planning needs to go in and looking to determine whether or not a person should be utilizing their foreign tax credits or whether or not they should be utilizing exclusions. The benefits of moving the approach towards a foreign tax credit is, like I said, with the 2017 tax reform, when that kicked in, there was a lot of people who didn't have enough foreign tax credits in their different brackets that exist in the US. And the US actually has two primary, although there are more brackets right now, two primary brackets of general, which is more kind of your earned income type of approach. And then you have the passive, which is towards most of your investment. So what happens when people use exclusions? The foreign tax credits basically get zeroed out and aren't available for carry forward. In the US, foreign tax credits can carry forward for 10 years. So it's actually beneficial to create this basket, if you will, of foreign tax credits in case there's things that happen. Some things that happen potentially, sale of a principal residence, where Canada, it's fully excluded. So you're not going to actually have Canadian tax on that. Whereas in the US, it's limited in the amount of exclusion that you can have. So it might be beneficial to have those foreign tax credits carried forward. Other things that happen are, the lifetime exemption amount for qualified small business shares or qualified farm property, where in Canada you may not pay tax, but in the US that just doesn't exist. So you have a US tax liability that's going to come up if you don't have the foreign tax credit carry forward numbers. One item that we see more on a frequent basis is capital dividends, where you can pay a capital dividend from the Canadian corporation out to its shareholder. Again, not taxed in Canada. The US doesn't recognize that, and it's taxable. So the kind of the gist of this is the foreign tax credits are your friend, if you will, for future use and for carryback in some instances. Another way that you can create foreign tax credits is by married filing joint. So there are situations where a U.S. citizen is married to a non-U.S. person, but they can elect to have their spouse treated as a U.S. person. If there's the potential to have some foreign tax credit bump up, if you will, by including the spouse within their return, that could be beneficial. You have to look at the pros and cons of it. What type of assets do they have? Is there going to be a benefit for the foreign tax credit as compared to the reporting that may need to be done? But it is something that definitely should be looked at by each U.S. person, whether or not they want to make that election to have those foreign tax credits added in. And in the past, sorry, go ahead.
No, go ahead.
No, you can go ahead. Ask your question.
I was going to say, we prepare tax returns, and the biggest single mistake we see tax return preparers do is they say, as long as I have the U.S. tax down to zero, I stop.
That's right.
Because, my client's happy. They don't owe a U.S. tax.
That's right.
Oh, but you don't know when they're going to owe U.S. tax. Krista's already pointed out that there's a bunch of scenarios, and this is only a handful of them. There's more is what I'm saying, of situations where the U.S. tax is higher than the Canadian tax.
Yeah. You
don't know when you're going to need those foreign tax credits. And as Krista said, there's a 10-year carryover. Now, this is something I tell our staff here. Foreign tax credits are like cash in your pocket. Nobody would lose track of cash in their pocket, right? You just have to find a place to spend it. And as Krista noted, in 2017, when the U.S. transition tax occurred, we were scrambling to find foreign tax credits to offset the U.S. tax that occurred in that year. And oftentimes people hadn't done that. If the interesting thing here is people who hadn't filed tax returns actually had an advantage, because we could go back up to 10 years to carry forward foreign tax credits all the way to 2017 to offset that tax. Foreign tax credits are not like a miracle worker there to solve people from being double taxed, but they're going to go a long ways to getting that right. So foreign tax credits are really important. And the things Krista mentioned, things like, married filing jointly, generally not that desirable a thing to do. Usually doesn't have an adverse tax impact, but by getting those foreign tax credits to be positive. Itemizing deductions rather than taking a standard deduction. Those types of things, and making sure you get all the itemized deductions, things like property taxes, mortgage interest, all those things that oftentimes get ignored by tax return preparers are really important for people. Getting more foreign tax credits, it's important.
That's right.
You just don't know when.
Yeah, and like you said, you don't know when you might need those and what might come up in someone's life. There are situations, as Warren alluded to, you kind of have to look at the full picture versus looking at a return and going, I just want tax to be zero. You need to look at an individual, where they're going, what their plans are, where they see themselves in 10 years. You have to look that far out, because today might affect their tax in 10 years. You never know, right? So
we're going to flip around, talk about investment in Canada now. And if we can get our picture advanced there, we'll do that. And we're going to talk first about something called controlled foreign corporations. Now, you may know that anything that has a special name is probably a bad thing. And controlled foreign corporations do create problems. These are principally for U.S. citizens and green card holders, because green card holders are still U.S. persons. And even if their green card is expired, they're still a U.S. person. So we can talk about that in the question and answer session potentially here. But this is focused principally on private entities here, private corporations. They're a controlled foreign corporation if 5 or fewer U.S. persons hold more than 50% of either the votes or the value of the corporation. So again, privately held Canadian corporation, not U.S. corporations, it's Canadian corporations, or for that matter, Argentinian or Australian or Zambian, any non-U.S. corporations. And there's 2 categories here that we'll talk about: GILTI and Subpart F income. Now, until 2017, we only talked about Subpart F income. Subpart F income is principally investment income. Now, I'm going to caution you about that because it's not exclusively investment income. And investment income meaning, interest, dividends, rents, gains, those can all be Subpart F income. Rents are kind of an interesting one because they can flip either way, depending on the underlying facts. But there's Subpart F income. But Subpart F income can include services income. And this is something called, foreign personal holding company. More names you don't want to know about. But be careful, especially the incorporated professional can fall into Subpart F income. So what's the bad news about Subpart F income? The bad news is the income earned in the corporation is attributed to you, the U.S. person, for tax purposes, for your own personal tax purposes in the U.S., despite the fact you never received any income. Now, this is a problem because in 2020, the U.S. has taxed you on those earnings in the corporation you never received, but Canada's not doing that. So we talk about double taxation. This is an issue because you're going to pay U.S. tax on it in 2020. In 2022 or 2023, you pay out the dividends and you pay Canadian tax, but you can't carry back the Canadian tax to offset the U.S. tax. And Canada won't accept the U.S. tax as a credit against the Canadian tax. So it's a double tax situation. So you want to be very careful about Subpart F income and the potential adverse tax impact that it can have on you. Now, so that's it for Subpart F income. We're going to talk about GILTI, global intangible low-taxed income. You say, that can't apply to me. That applies to Starbucks and Apple and Google and, they got a bunch of stuff they park in Ireland or the Bahamas or something like that. No, unfortunately, this applies to you. You never thought yourself as being low-taxed in Canada, and you say, I don't have any intangibles. I don't have any trademarks to Disney or something like that. But GILTI is going to apply to you. Basically, the GILTI tax is saying it's going to create GILTI income out of your corporate earnings. And if they're and you get a 10% return on hard assets. But if it exceeds that amount, so if you own an ice rink and the 10% return, that's $1 million ice rink, let's say, and it's $100,000 is 10%. If your earnings exceed that, that's going to be your GILTI income. Now I'm simplifying this, and you're going to be taxed again on that personally in the year earned, even though you didn't get any dividends. There was no distribution from the Canadian corporation. Now, the issue typically isn't because you own an ice rink. It's usually because you don't have much of any assets. And I'm talking about us here, right? Incorporated professionals, investment companies. Incorporated professionals, you've got some computers, some desks, some chairs, and tables. There's not much of a return on those. And so all that income becomes GILTI income and gets taxed you personally. And again, this levers up the risk of double taxation. So this is potentially a real problem to people. Are there solutions? Yeah, there are solutions here. Some people say, well, I'm just going to pay out all my earnings out of the corporation. Well, just hang on. You incorporated because you're going to achieve a Canadian tax benefit. And to pay out all your earnings just defeats that entirely. Now, that may be the answer at the end of the day. But it seems to me, Canadian tax is still higher than U.S. tax. So what you want to do is take a more nuanced approach. And some of those approaches, there's a variety of different approaches here in terms of doing things like converting your entity, especially for professionals, into an unlimited liability company. There may be some problems in a regulatory fashion on that because not all professional associations accept ULCs. And ULCs, both Alberta and BC have ULCs, some other provinces do as well. And they have some unique attributes too associated with them. There's other solutions that get more complex, things like that. There are solutions there. Whether or not you think they're a solution, we can debate that after we look at your facts. But there are solutions there. But you need to be mindful of this issue about GILTI and Subpart F income. So we're going to flip now. And we've talked about controlled foreign corporations. And we're going to talk now about passive foreign investment companies. I know all the financial advisors should know all about that. So let's flip to that next slide.
Yeah, the favorite question of, can I invest in this mutual fund? Passive foreign investment corporations is a tested item within the Internal Revenue Code that they say a corporation is considered a passive foreign investment corporation if greater than 75% of its gross income is passive, or greater than 50% of its assets are passive income producing assets. This could be cash. So sometimes you have instances where you have, as Warren alluded to before, you have these service corporations where they're continuing, they may not control the corporation. So this is for corporations who are not controlled by the US people. You may have an instance where they've accumulated a significant amount of cash and or investment amounts, and you've all of a sudden created a passive foreign investment company. Although it's not always the end of the world to have a passive foreign investment corporation, as Warren alluded to, there's planning that can be done. You always have to look at the cost benefit as to what does it mean to have this asset for me and what is my earning potential as compared to the reporting and the planning around the distributions in order to elude the excess distribution that is always the calculation people don't want to do on it's basically kind of the punitive section of the passive investment form.
Yeah. So Krista, most of our clients don't necessarily have a problem under that gross income test. They have a problem with this asset test.
That's right. So it's the assets. As I said, when you get a corporation, if you own 40% of that corporation and you're just allowing it to stack up cash, but there's not really any other tangible assets within that corporation, you've now created a passive foreign investment corporation or company. Now, the thing with the passive is once you're a PFIC, you're always a PFIC, unless you're doing a purging type of situation. But this is something where 1 year you can go offside by accident. And then from that point forward, you have a situation where you're looking at that corporation as a PFIC.
Once a PFIC, always a PFIC. That sounds like a disease.
It kind of is. It's the tax reporting disease, I guess. I don't know. But yeah, so I mean, there is solutions, as I said. You can do, there's different types of purging elections or mark to market or the qualified electing fund. There are different situations in which you can, in advance, when it first happens, have it be reported as you want it to be reported. But if it's already in existence and there's no going back and fixing it, if you will, you have to go forward.
Yeah, it's a forward-looking thing. And the challenges about PFICs are that you end up getting taxed at 37% rather than 20%.
Yeah, so the income rolls out as ordinary income, and it gets taxed at, right now it's 37% is the top marginal bracket. So it gets taxed at that top marginal bracket, whatever it is for the year in existence. Foreign tax credits are permitted, but it's restricted and they're used in a different way. So you can have a situation where you have, as we keep referring to, the double tax potentially on this type of income.
And worse yet, to add insult to injury, you've held this stock for 20 years. It's been a total dog for 19 of them. In year 20, they call it, I'm going to use GameStop again. Suddenly it's worth kabillions. Now, GameStop's not a good example because it's a U.S. company, but
that's right.
Do we have a Canadian equivalent of that? Suddenly it skyrockets in value. The U.S. is going to charge you interest on the tax you notionally deferred, even though all the gain occurred in that last year. It's going to be pro rata over your ownership period. So you could actually have a tax and an interest charge that actually exceeds your gain.
That's right. Yeah, you can have it, and it is punitive. And then you also have to look at the reporting. So U.S. persons, you have to pay for each PFIC that you own to report that. So not only are you paying extra tax at the 37%, having the interest charge on the deferred income, you also have to report. So a lot of times, unless it's going to be a huge win investment-wise, it's certainly not a win for the individual.
So this sounds like it's good for accountants, but not good for accountants' clients.
Yeah. we don't like to talk ourselves out of work, but in these situations, we advise not. It's just better off not to have it. Now, in saying that, there are situations where you could have a legitimate business that ends up being a passive foreign investment company. But then again, you just need to plan, because you're going to have enough of a say to in order to create that investment and how you flow through the distributions.
So what I like to think about in situations like passive foreign investment companies is that it's not whether they should or shouldn't make an investment in something that's going to be a PFIC. It's understanding the costs associated. Okay. There may be a higher U.S. tax cost, a higher compliance cost. What are the solutions? The good news is that despite the fact that the PFIC rules came about in 1986 with Ronald Reagan, most mutual funds in Canada only really got religion on the whole thing in after like 2010. And there's still a lot of mutual funds in Canada that do not put out PFIC annual information statements. Most of the larger ones do. So that QEF election helps. It's not perfect, though. And that's what you need to understand. As investment advisors, you need to be thinking about saying, this is a good solution. It'll solve most problems. It doesn't necessarily solve all problems.
Yeah, exactly. Yeah.
So we're going to flip to another subject right now and talk about Canada Pension Plan and U.S. Social Security. Now, this is like foreign tax credits. Everybody ignores this issue until it's too late. And Social Security and Canada Pension Plan just kind of get ignored.
Warren, do you want to forward the slides there?
Yeah. There we go. So let's just walk through it. Canada Pension Plan, of course, we know it as CPP. U.S. Social Security, if you're a U.S. Employee, you'll say on your paycheck, it shows up as generally as FICA, which stands for the Federal Insurance Contribution Act. I think that's 1934, actually, is FICA, but that's better known as Social Security. And what you can see here, if someone's making $100,000, I put it all in U.S. dollars for simplicity, the employee and employer in Canada would pay about $5,000. That same person and same employer, if they're in the U.S., would be paying about $15,000. Wow. If you move from Canada to the U.S. and you see your paycheck, you say, ouch, that's a lot of money. The U.S. is really expensive. If you look at someone making $500,000, it's still $5,000, and they're paying $34,000 in the U.S. for that. And if you're talking about someone who's making $1 million, I know that might not be all of us in today's meeting. Canada's still $5,000, and the U.S. is $53,000. Now, what's important to note here, as I say, this is U.S. Social Security and Medicare. Of that $53,000, about $29,000 is Medicare. And you may think you're getting a nicer hospital bed or things like that. You know, you're not. And you may think that U.S. Social Security must be worth it because the return on it is about triple. In other words, your benefits under Social Security are about triple what Canada Pension Plan are. So isn't that a good deal? Remember, this is a government-mandated savings plan. If it was such a good plan, we'd be throwing money at it. And it's interesting here as Canadians beat our chest a little bit about Canada Pension Plan Investment Board and their great decisions. You know, you can get a way better return by just investing at, the Royal Bank of Canada and getting, sorry about the RBC comment, 0.75% on a, 5-year GIC. You'll never get a good result here. Now, I had the privilege at one point in my career of being involved with a multinational company, a client, that we did an actuarial study because when American executives came to Canada, they said, I must stay on U.S. Social Security because I don't want to diminish my benefits. The conclusion of that study was that even if it was the very last payment they would make into U.S. Social Security, and that by not making that payment, it would diminish their benefit, it was never to their advantage to make the payment. Now, the only question became as to what was their alternative, because they'd have to either pay into U.S. Social Security or Canada Pension Plan. This is the only benefit Canada Pension Plan has. It's an equally bad plan as U.S. Social Security. And forgive me for trouncing over a lot of people's views that this is money from heaven. Remember, you put into this plan through your whole career, and now you're getting paid on it. But the only advantage of Canada Pension Plan, it's less. You're paying a lot less money, and you can use those other monies to do that. So Canada Pension Plan is not a great plan, but it's better than Social Security because it's less. And it gives you the ability to take those additional monies to ideally invest them for retirement and get a better return, or use them to buy the boat or pay off your home mortgage or whatever you need to do with those monies. So Canada Pension Plan is a big deal. One other note on this subject is on this just to show you how big an impact potentially Joe Biden makes, is that under his plans, this number for a guy making $1 million, at $53,000. Remember, that's split between the employee and the employer, but this amount would jump to about $130,000 total. Now, payroll taxes are job killers because they really cost employers, but they also cost employees too. These are big costs here. So
yeah, they are.
So they're significant. Now, we've got a little extra time here, and we're going to do one little bonus section here. So we're going to move to transferring U.S. retirement accounts to Canada. And Krista, you're going to talk about this.
Sure. Yeah, I'm gonna quickly highlight this so then we can get to some of your questions, because I understand there's some questions out there. When we're looking at the age-tested question is, how do I get my U.S. pension to Canada? And this is something that I would say we probably get at least once a week. Someone emails or phones us asking, how do I get my IRA or 401k to Canada? In taking out your U.S. pension, there is going to be withholdings. If you're taking it out before 59 and a half, there will be a 10% penalty as well. Now, oftentimes we hear people asking to roll them over into their RRSP, which with the correct steps is a possibility under the income tax to do that, even if you don't have RRSP contribution room. But there can be inherent problems in doing that because you're going to have had the U.S. tax paid and withheld on the distribution. If the individual who makes the rollover into an RRSP doesn't have enough other income, if you will, to use these tax credits, you could have a situation where you're bumping up your tax rate that's going to be eventually paid on that RRSP when you then again withdraw it, because you would have the U.S. tax now and you are going to have the Canadian marginal rates in the future on the RRSP withdraw. Now, there is some benefits to doing this. You know, you no longer will have U.S. situs assets. So if estate tax is of concern to you as an individual for your total worldwide estate value, it might be beneficial to get those assets out of the U.S. so you're no longer exposed to that estate tax regime. And convenience, ability to potentially manage those accounts a little bit better, a little bit more effectively, and get a better result. It really, at the end of the day, it's going to be an individual by individual calculation to determine whether or not it's beneficial to move that U.S. fund or pension, up to Canada.
Excellent. I'm sure we'll have some questions on that too. Yeah, so exactly. We'll flip to the last section of our session here. And that's time for questions. And please do complete the survey. You know, tell us how we can improve, topics you'd like us to cover, and we're going to stay for questions. Now, we said there'd be an hour. We're about we're close to an hour right now. You're welcome to stay as long as you can, and we're going to try and answer the questions. We understand there's a number of questions there, so I'm going to give this to our and thank you for attending too. I'm going to pass this off to our question person, Emily. And do you want to ask us the questions, Emily?
Good morning. We do have a number of questions. Let me start with this one. This person asked, if I'm a green card holder living in Canada and my green card holder expired, am I still considered a U.S. person?
Yeah, I kind of tipped you off on that one earlier, actually, is that think about this. The green card is the colloquial term. The actual term is lawful permanent resident. So suddenly that green card takes on a different atmosphere. In other words, the fact that the card might expire doesn't mean that your status expires. As long as you have a green card, whether you hold it in your physical possession or not, but unless it's been actually formally abandoned, there's a process associated with doing that, or judicially rescinded, which is usually a really bad sign, you're still a lawful permanent resident of the United States. And therefore, you have all the obligations of a U.S. person. The issue here is that, and that would include filing a U.S. tax return. You can elect under the treaty or claim under the treaty that you're actually a resident of Canada. It may result in your green card being invalidated, but only if U.S. immigration actually takes it from you. Now, they don't generally go to Prince Albert, Saskatchewan, or Brandon, Manitoba. or Lethbridge, Alberta, to go get that card from you. So it's usually going to happen when you're crossing the border. But so you have all the rights and obligations, and I'll say most of the obligations associated with being a U.S. person. And the abandonment of that card may have some adverse U.S. tax implications to you. So you want to be very careful with that process. We definitely advise getting professional advice, and we can work with you on subjects like that.
Thank you, Aaron. Now the next question is, while living in Canada and if subject to both Canadian and U.S. tax law, are there risks or complications to investing in U.S. stock, not in through mutual fund from Canada?
Yeah, I think, are there risks associated with investing in U.S. stock? The biggest risk that a person could be exposed to in investing in U.S. stock is the estate tax, because they are considered to be U.S. situs property for purposes of estate tax. As far as complications on an annual filing basis, it creates a situation in which you have interacting foreign tax credits and somewhat of a circular foreign tax credit, which could increase the complexity of the return. So it really depends on the quantity of it and what type of income are being earned by these stocks and the amount of it. But your biggest exposure in owning U.S. stock being in Canada I guess if you're not a U.S. person, would be to exposure for the U.S. estate tax.
The also owning U.S. stocks, you get dividends from U.S. stocks. They're taxed as ordinary income for Canadian tax purposes. There's no dividend tax credit associated with it either.
Right. Yeah.
And that could be a problem. Candidly, I think the bigger issue for people resident in Canada who have U.S. Securities interests is when they hold U.S. securities accounts. And there's two problems associated with that. One is they have a reporting issue in Canada under T1135. They're making it more complex for themselves. And Canadian advisors can simplify that process. The other one is that generally the people like Fidelity and Vanguard don't want to have residents of Canada owning their US-based funds, because now they have a securities issue. It's their problem. It's not the client's problem. And that is that U.S. investment advisors generally cannot advise Canadian residents unless they're registered in Canada. Now, there's more and more people who are registered in both countries, but it's still not that common. And as a result, that creates a securities issue there. So, and that can be a real problem for that particular investment advisor in the U.S. Even if the client says, I'm not getting any investment advice from them, it's E-Trade and they never talk to me about anything, it's still a problem.
The next question I would like to ask is, this is regarding PFIC. The question is, are all Canadian mutual funds considered PFICs automatically without any options?
You want me to take that, Krista?
Yeah, you want to take it? Sure.
Sure. So, no. Should Americans never own a Canadian mutual fund? No. Here's the real problem. It's typically for the small investor, and I'm not sure what that definition. But if you talk to someone less than $1 million in their investment portfolio, it's very difficult for them to diversify their interests, and that's a challenging thing to do. And so that's why commonly, mutual funds and for that matter, exchange traded funds make a more substantial part of their portfolio. Now, the issue here then becomes, what's the impact from a U.S. tax perspective? And as Krista pointed out, there's a bunch of problems here that comes up. Are these problems, do these become the big problem? Not necessarily. And the issue here then is how can they minimize those issues? The first one is that investment fund issues something annually called a PFIC annual information statement, because then the client can make something called a QEF election. And that's going to simplify their tax affairs and also get them out of the adverse PFIC regime. But the important issue, it can only be done in the year they acquire their interest. So if they've held that investment for several years and then they want to make a PFIC, they have to, Krista used the term earlier, she said, purge its PFIC status. Essentially, it's like selling it. And then they can make the QEF election. Otherwise, they're going to end up with the worst of both worlds. And it's called, they even have terms, it's called an unpedigreed QEF. That means it's still a PFIC, but now it's also a QEF. So that's never a good thing. So you need to purge the PFIC status so it's just a QEF at that point in time.
Mm-hmm.
Next question.
The next question is, how does one take advantage of continuing to pay into CPP rather than U.S. Social Security?
Sure. Do you want me to take that one, Warren?
Sure.
Sure, yeah. So if individuals are going across the border, either in an intercompany transfer or as a business person, there is the possibility to apply to Canada Revenue Agency to continue to pay into CPP. This is typically more for temporary transfers. Their initial approval is for 5 years, although you can extend it for a couple more years. But this, like I said, this is intended just to be a temporary measure. If it's someone going to the U.S. on a more permanent basis, there's generally not a way that you can ask to continue to pay into CPP and not pay into the U.S. Social Security. So although it is, and I think the question was, what's the form, the CPT 56? But I mean, everything's always evolving. So you always want to look at what's the best answer for the long-term plan, short-term plan, how are you moving? But yes, the short answer is yes, it is possible to continue to pay into CPP.
So that's for Canadians moving to the U.S. Yeah. When Americans come to Canada, I'm glad someone asked the question because the issue there is the same in reverse, is Americans transfer to Canada on a temporary basis should continue to be subject to U.S. Social Security. Now, if you remember the numbers we showed on the board, especially if you're a high income person, this really ramps up. It's very expensive. They should choose to be on CPP. They don't actually have a choice in the defined, how that's defined, but what they want to do is make it so it's not a temporary transfer. Now, Krista alluded to it. Temporary is never defined in the Canada-U.S. Social Security Agreement. But it talks about something less than 5 years. And so, if they have a contract that's more than 5 years, then they wouldn't be temporary. If it's viewed by all parties that it's more than 5 years, even without a contract, that may be substantive. CRA has made some informal comments that say if the U.S. company can fire the guy that's been transferred to Canada, then they still control his employment. So you need to be thinking of ways to get them out of that. And even though the U.S. person will often be protesting, after you kind of walk through the facts, and they're going to say, thank you for saving me from my delusion that these savings plans were actually in my best interest. And I could put all that money, that, $20,000 or $30,000 that I would have spent, and putting it towards my own retirement or, paying off the mortgage. So I notice our time is just after 1 o'clock. We'll answer a few more questions here. Thank you so much for joining us. If you want to sign off, you're absolutely welcome to do that. You may have done that already. But we'll try and answer a few more questions, and you're welcome to stay with us if you'd like to do that.
Yeah, Emily, if we don't actually get to all the questions, do know that we have recorded all the questions. So if you're anonymous question asker, just send us an email and we'll make sure to get to your question. But for those who ask the questions with your name, if we didn't quite get to you, we'll follow up with you afterwards personally.
Hey, Emily, any other questions?
There are a few left. Let's answer this one. In terms of departure tax and the posting of security, what is the most common form of security posted when dealing with private corporate shares?
Well, it's usually the assets that result in the the tax. So, if your shares of your private company are the thing triggering the gain, oftentimes you provide that as secured to CRA. That sounds terrible. Actually, I'm going to give my shares to my ABC company to CRA. It's not quite as painful as it sounds and not necessarily as restrictive. But remember, they're giving you a tax deferral and an interest-free loan in essence. You could continue to hold those shares until your death, and you wouldn't actually have to pay the tax. Unfortunately, if you die, you'd have to pay the tax at that point in time. That's a bigger subject.
Yeah, there's also a way to have an institution help put forward funds on a contingent basis, if you will, as security.
Like a letter of credit.
Like a letter of credit. So there is a cost to that, but that is always an option as well. If for some reason Canada Revenue Agency doesn't accept the private share.
Yeah, for our bank advisors are online, whether it's TD or BMO or Bank of Nova Scotia, whatever, those letters of credit go for typically 1% to 2% somewhere in there. So yeah. Now there is a cost of putting that forward, but it's still a bargain compared to paying tax oftentimes.
Yeah. Exactly.
And, that's something you'll have to weigh there. That's why giving the shares is a really low cost solution in that respect.
Yeah.
And just one other point too, if you're still on the line, make sure you do the survey too. We want to hear from you on this, and I can change the color of my tie, or we'll tell you about all the production things, and you can tell us what things you really liked and what things you really didn't like, and we're okay with that. Emily, more questions?
Yes, the next question is regarding controlled foreign corporation. Does the U.S. person have to own more than 50%, or is 50% ownership also applicable in this instance?
Well, if we're talking about share ownership, it would have to be more than 50%, but you also have to look at value and or votes. So they could own 50%, but they own the 50% total value, but actually control all the votes. So in that instance, it would be controlled foreign corporation. So it's dependent on how the share articles are written, but typically they have to control the corporation in some way.
Yeah, and that's a good point, Chris. So it's either votes or value. Either one, if they're over 50%, you're going to be a controlled foreign corporation. Now, one of the interesting things that didn't come up when we chatted about PFICs is oftentimes spouses will split the ownership. Now, in the case of professional corporations, typically whoever is the professional has to own all the voting shares. So they're automatically going to be into the CFC category. But if you're talking about corporations that are not professional corporations, just a regular corporation, and the husband and wife split it 50-50, where they each own 50% of the votes, 50% of the value, and one of the spouses is a U.S. person, it will not be a controlled foreign corporation. Now, they have some filing obligations regardless, but then you're into the PFIC rules potentially, again, if you meet one of those tests. And so which is better? People say to me, Warren, which is better? Would I rather be a controlled foreign corporation or a passive foreign investment company? I said, that's kind of like asking me whether I want to be, shot or injected with something. I mean, neither of those are really good choices, but if I had a choice, I'd generally choose the controlled foreign corporation because it tends to be more controllable and more on a current basis.
Yeah.
PFICs have a problem, as Krista mentioned, is that once a PFIC, always a PFIC. 20 years later, your shares in TELUS International, this new stock that went out last week, are now worth millions. And then you find out it's a PFIC. And suddenly you're like frozen and you're stuck. And nobody knew that until you sell it. And now all the accountants around you are looking like you're a leper. So, I generally prefer controlled foreign corporations. Ideally, you can avoid them both, and that is possible. But remember, your goal is to reduce your overall tax, not to reduce just your Canadian tax, and not just reduce your US tax, it's your overall tax. And then factors you need to consider saying, what is the cost of this? And there is a cost, that's a real one. And, cost of filing a tax return suddenly is very expensive, very complex.
Yeah. Are there any other questions, Emily?
There are a few more questions. Some of them are a bit more detailed, and perhaps we can follow up with participant privately. But let's end with one more question. How does that sound?
Sure.
This is related to the treaty tiebreaker rules. And the question is, how does being a green card holder affect the fourth treaty tiebreaker rule, which is citizenship?
It doesn't affect it. It's a question of citizenship, and having a green card doesn't make you a citizen of the U.S. It's a question of citizenship. So green card doesn't actually enter into the treaty tiebreaker. But remember that under U.S. rules, if you've got a green card, regardless of where in the world you live, and it hasn't been formally abandoned or judicially rescinded, and the fact that the card has expired means you're still a U.S. resident for U.S. tax purposes, whether you're living in Canada, in Iceland, in Italy, or any other country. Hey, thanks so much for joining us for this webinar. We've enjoyed having you here. Do complete the survey. Appreciate your involvement, your questions, and I'll say goodbye from my end. And Krista?
Yeah, thank you very much. And as Emily and Warren alluded to, you can follow up with us if we didn't get to your question. We'd be more than happy to go through that with you personally. Have a wonderful day, everybody.
Thank you and goodbye.
Thank you. Bye.